want to talk about what's going on in Jackson Hole, Wyoming. Federal Reserve Chairman Jerome Powell speaking today after the Fed meeting wrapped up there. And this is what he said about inflation, about potentially cutting interest rates. He said this, quote, "The time has come for policy to adjust." Now, what does that mean? Let's talk about all of this and more with our friend at the American Institute for Economic Research, William Luther. He joins me. All right, William, good to see you. You and I talk so much about where inflation is going, where interest rates are going. Is it all but certain now after Powell said what was somewhat glib and somewhat vague? I would argue, I'm going to say it again, the time has come for policy to adjust. Is it all but certain that that means that is being telegraphed as a rate cut in September? Or is there room for movement in that very pithy statement there?
I don't think there's any room for movement.
Okay.
This is about as close as you're going to get to seeing Chair Powell say that rates are going to come down in September. If you remember back to the previous FOMC meeting, he wasn't even willing to say then that that the Fed was going to cut in September. He was saying, well, we think that might be on the table in September. But when he says the time has come for policy to adjust, that is pretty clear. The FOMC is going to be cutting rates in September.
Okay, so let's operate on that basis and that assumption here. Let's talk about what the cut might be. 25 basis points, 50 basis points, 75 basis points. Is it going to be modest or larger?
Well, markets are currently pricing in a 25 basis point cut in September. And I think that's very reasonable. This is a slow-moving Fed, the slow-moving Fed that got us into some trouble by moving so slowly when inflation picked up. And I don't see them changing pace anytime soon. So they're going to be a little cautious to cut rates here. And starting off with a 25 basis point cut strikes me as the most likely outcome. The big thing, though, for me is seeing what markets are pricing in for the rest of the year. Remember, we have an FOMC meeting in November and then again in December as well. And currently, they're pricing in a 50 basis point cut for November and then another 25 basis point cut in December. So that would see us closing out the year with the federal funds rate target 100 basis points below where they are today. That's a pretty big move in a short period of time.
Yeah, and we know the federal funds rate right now is at a 23-year high, so that would be significant as well. What do you think went into this incoming decision by Powell to be so bullish on an interest rate cut? Was it the CPI report that we got just a couple of weeks ago, inflation falling below 3% on an annualized basis for the first time in 2021? Are they nearing that 2% target rate, and do they feel comfortable with it? Is this a soft landing, William?
Well, I think that it's really a host of incoming data. Powell has stressed that the Fed is data dependent. And what we've seen is, to use his phrase, the labor market coming into a better balance, supply and demand coming into better balance. And it's striking that in today's remarks, he was no longer talking about things coming into better balance. Instead, he was saying that the upside risk to inflation had diminished and the downside risk to employment had increased. So I think he's looking both at those falling inflation numbers, the CPI averaging 1.9% over the previous month on an annualized basis, and just 0.4% over the last 3 months on an annualized basis. And then, of course, the unemployment rate ticking up as well.
Let's talk about the unemployment rate and jobs specifically. You and I have talked extensively about how much the job market has been roaring, and I think that has been plain as day to see. But we got news from the Bureau of Labor Statistics just last week, putting out some major downward revisions in the number of jobs created over a period from March, I believe, or April of last year to March of this year. 818,000 jobs were downward revised. That is a huge number. Now, how does Powell, interpret news like that when making an interest rate decision here? Does he take that into account? And what does that speak to the overall job market? Is it as healthy as it's been projected by the Bureau of Labor Statistics? Did that piece of news give you pause going forward? Is that recession level worries?
Well, I think certainly he takes that into account, right?
Okay.
What it means is that the data that he was basing his decisions on previously were more favorable than or appeared more favorable than they actually were. In terms of the state of the labor market right now, I'm not so concerned on the employment front. And the reason I'm not so concerned is if you look at prime age employment, that is Americans who are between the ages of 25 and 54, you'll see that about 81% of those Americans were employed at the end of 2019, just prior to the pandemic. And about 81% of those Americans are employed today. And so for the bulk of the population that is in those prime working years, we see that they are in fact working in line with historical levels. The thing that concerns me is how slow real wages, that is inflation adjusted wages, have grown over the last few years. The pandemic recovery seems to be over. Real GDP has not quite converged to its pre-pandemic trend, and real wages haven't grown as fast in the period since 2020 as they were growing prior to 2020. So I'm more concerned about that in the labor market, that slow real wage growth, than in employment at the moment.
So, William, if we're getting a period of time in this quarter or annualized basis from April of last year to March of this year, that shows that the monthly jobs reports really can't be trusted because they're either upward revised or downward revised. Why do we put so much stock in the Bureau of Labor Statistics when they put out the jobs numbers for the month prior on the first Friday of each month here? Has that agency, that federal agency, has it lost credibility if we're talking about an 8,000 job revision downward, 818,000 rather?
Well, it is a very difficult job that those economists do at the BLS,
Okay.
and so I'm sure they're trying their best, and it's a tough thing to do. But that series is just very volatile. Even in normal times, you see those numbers being revised quite a bit from month to month, and sometimes they're revised up, and other times they're revised down. It's a very volatile series. But of course, we haven't been living in normal times. We've been living in some pretty extraordinary times where the job growth that we've seen has just been enormous. And of course, it was enormous because so many people lost their jobs
Right.
in the early days of the pandemic. And so when you're talking about a change in magnitude of that size, it's not surprising to me that you could be off by a considerable amount.
All right, we're going to have to leave it at that. William Luther with the American Institute for Economic Research. Can't thank you enough. Have a good weekend. We'll talk soon.
Thank you.